is that as soon as you enter a position, you're no longer unbiased. Okay, you have a bias. You want to make money, and that can influence your decision. So you always want to come up with these placements before you have money at risk. Last but not least, we have the topic of pyramiding, which is probably my favorite topic to cover because I love talking about how to increase our profit potential without increasing the risk. So what is pyramiding? It is strategically adding to a position as the market moves in our favor. So you never want to add to a position if it's losing. So if you short the market and it takes off to the upside, you don't want to add to that. So we want to add to a position as it becomes profitable. As far as timeframes go, I have found that anything above the 4-hour time frame is the most reliable. Okay, and you want to avoid dropping below the 4-hour time frame when adding to a position. And a little bonus tip here for you is if you're just starting out with price action, you want to avoid dropping below the daily time frame. Okay, so if you're just beginning, try sticking to the daily time frame until you become consistently profitable. Once you do that, then you can start experimenting with the 4-hour. As an example, if we were buying this market, all right, so if this market was in an uptrend and it broke above this key level, let's just assume that this is the daily time frame. So a daily session closed above this level down here, retested it as support, so we'd want to buy right here. Now, the second position comes in once the market comes up here and closes, and again retests this level up here as new support. So at this point, we've got 2 positions on. And really, we're just doing the same thing up here. Market closes above. We're buying again, so we've now got 3 positions on. Now, you may be wondering, well, that's great and all, but we've now got 3 positions on. It sounds like we may be over leveraged on that position, but here's the beauty of pyramiding. The entire time that we're adding, as the market moves up, once we put on the second position, we're trailing our stop loss. Okay, so we're trailing our stop loss up here, and we are now in a no-lose situation. Once the market comes up here, breaks this level, and we put our third position on, we once again trail the stop loss. And once we're up here, we are in a no-lose position. Okay, there's no way we can lose position up here or lose money up here because we've now trailed our stop loss. We've got a buy here, another position here, and we're adding again up here, but look where our stop loss is. All right, so the beauty of this is that we're trailing our stop loss as the market moves in our favor. Let's bring that all together, and then I'll wrap up with an example on a chart. So in terms of percentages and our multiples, we're risking 2% on this first position. The market then rallies higher, closes up here, retests support. At this point, we're putting on the same size position, right? We're putting on 40,000 units. And again, our risk is 2%, okay, at 40,000. And so we're moving our stop loss up here into a break-even position. The market closes above the next level. We buy up here, again, trailing our stop loss. So notice that the position size is the same all the way up. Okay, so in terms of percentage, what that does is it turns a 6R, right, an R multiple, which would be 12% profit if risking 2%. It turns that into a 24% profit or 12R because these 2 positions added another 12% profit or 6R. Okay, 4R plus 2R right here, those 2 positions. So now you're not going to get a lot of these setups like this, but let me tell you, even if you just get a few of these each year, which you can do, it can really add up. All right, so that's the beauty of pyramiding is that we're increasing our profit potential as the market trends, and we're also covering our risk along the way. All right, so let me show you an example now on the Australian dollar versus the USD. All right, so we've got the Australian dollar versus the US dollar here on the daily time frame. And the first thing I want to do, and just so you know, this is how I had my chart set up at the time. So I had this trend line up here drawn across these 2 highs. All right, so we had this trend line, and you'll notice what happened here is the market had come up here and sort of just churned sideways, but slightly higher, right? So this was the consolidation that I was watching, and believe it or not, but that was actually a sell signal, and let me show you why. This is called an upward sloping flag, and it's actually something that I also teach. So we had this consolidation right here. All right, so it's kind of the opposite of a bull flag. In a bull flag, if the channel had formed at